G'day expats, welcome to another episode of Expat Chats. Today we're ticking off episode 17. I'm joined today with Brett Evans, Managing Director of EMEA, and myself, James Ridley, Managing Director for APAC. How are you going, Brett?
All well on the hood here in Dubai. Things are on the improve COVID-wise, which is good. We're starting to enjoy a little bit more freedoms and things are starting to loosen up a bit. But as I mentioned before, there's a bit of a political tussle right now between Abu Dhabi and Dubai when it comes to how they want to deal or cope with the coronavirus. So it's created a few
border
nuances. Border, yeah.
Border control, is that right?
Yeah. So it's very similar to what's happening in Australia, in terms of the borders,
Queensland,
closed.
New South Wales.
Yeah. But the difference here is that no one's getting approvals to get through, as opposed to if you are a resident in Queensland, you can actually get through. But even if you're in Dubai and you are a resident in Abu Dhabi at the moment, you can't get through. So look, it's thrown up a few curveballs for a lot of people, that's for sure.
Yeah, absolutely. I mean, living in Queensland, I actually went down south to New South Wales last week to Coffs Harbour, catch up with some family and friends. And for Queenslanders, it's very easy. You print off this one pager, you put on your windscreen, you head down. Whereas New South Wales locals, they can't come past the border at all. They either can get fined or turned around. It's crazy. But I suppose we are starting to see potentially that second wave in Victoria back in Australia. I think they're up to 131 active cases. They were meant to, I think, release the border controls between Queensland and New South Wales. I think it's about the 9th of July, but I think Premier Anastasia is going to look at revising that in the coming weeks.
Like I said to you, before the call, I think I wouldn't say we're in the infancy of this pandemic, but we're certainly not through, the crux of it, that's for sure. I mean, if you look at, the WHO, they release their daily figures, and the daily new cases worldwide are still increasing. So worldwide,
that's right.
Where we still haven't, hit that peak yet.
Yeah, well, I think the other day they actually announced that it was the highest recorded day of new obviously cases, where we thought we had already seen that, probably I'd say 6 or 7 weeks ago, but we just haven't. Even though obviously locally in Australia we're doing okay, some countries are doing okay. Border controls in place probably till 2021 with travel and those sort of things. Bit of a second wave obviously happening out of China and Beijing. You've got another second wave likely happening in Australia down to Victoria. I think the
Germany,
US
United States too.
Yep. Yeah, that's right. I think Trump's, as usual, done it back to him and go, oh, hang on, no, we might look at changing things. There might be a second wave. So we'll see what that brings and how that translates to obviously the economy, share markets, those sort of things. A bit of an agenda rundown, or, a bit of a recap of what's been happening in the last few months in the markets, economy, those sort of things that we might see taking place over the next few weeks or months. And I want to go back over, firstly, concessional contributions, as well as what the catch-up concessional contribution is, because I think we can tie that into some strategies in the future that individuals or expats can use.
Yep.
And
I think let's get rid of the disclaimer too. So all information that you have the pleasure of listening and seeing is for informational, educational and fun purposes only, and should not be construed as personal advice.
That's right. I like that you threw in the word pleasure there. We're okay to listen to. That's good.
I think so. Yeah, I said, not to watch, but listen to is okay.
That's right. Actually, how's the hair clippers going now? No new haircuts?
The funny thing is I actually got this done at the barber, and I think my job was better. So I might actually be saving myself 60 dirhams, a haircut now, because I reckon once my wife and daughters return this weekend from Australia, I'll be able to do probably a more refined version of my last haircut, because as I said, I finally got the mirror behind there and it was dog's breakfast. But long story short, the haircut, I'm thinking I found the new way of clippers and number 19, number 6 on the side, and I'm done.
Bit of a buzz cut by the sounds of it. No, it looks
exactly.
good.
Yeah.
But anyway, mate, let's dive into it. So a bit of a market update. I've got some figures that I'll throw out to you as well. So, if we look at sort of the US at the moment, you look at sort of its drop through Q1. So obviously in between January and March, I think the NASDAQ dropped about 15.3%, dropped the S&P 500 20.54%. But gosh, we've seen some rallies since, haven't we? They've come back pretty strong.
I think it's
what's driving it?
Yeah, look, I think there's a lot of similarities we can draw upon from a lot of market events and not just, GFC related, but going back further. And, it relates, when you're investing, a lot of it is psychology based. So
Yeah.
the first thing you want to do, and you're always preconditioned to do, is to run in, because you see some people making some money, you have that fear of missing out, FOMO, and
That's
then
right.
it picks back up again. The run from May into June has been driven by sentiment of lockdown, coming out, but also to we're not seeing what I call the big money and the smart money coming in yet. So the recent rally, if you look at the volumes, has been driven by two primary parties: mum and dad investors and short sellers covering their short positions. So if you look at Robinhood in the United States, which is a robo-advisor, very much a, if you've got $10,000 and you live in Midwest America, you can chuck it in and it'll just do it all for you. Their account numbers are up 2,500% since March.
Gosh, okay.
It's crazy. And to me, the biggest thing we're seeing right now is there's a lot of that. But if I look at the Carl Icahns, the Warren Buffett's of the world, they haven't moved. Warren Buffett's still sitting on $137 billion worth of cash.
That's right. He's increased his cash position actually in the last 3 months. So he has a pretty good record. So it'd be interesting.
Look, I think he plays a cool hand, and I think we can take a lot from those people who've been through a lot and managing big money. Like I said to a client yesterday, we're not trying to bet the farm and find the latest and greatest. It is preservation of capital first, combined with generating a return from that. And when you consider we're dealing with the biggest economic event globally since World War II, and we're really only 2 months into it, almost 3 months into it in earnest. It's too soon to know what the ramifications are going to be. There's still more to play out with this, and to us, we're not, I guess, being suckered into this rally. From our point of view, we are seeing value, but there's not enough of a discount in the price to warrant taking on the risk of not knowing what's going to happen in the next month, 2 months, and 3 months.
Yeah, that's right. And I think a lot of, institutional investors, managers, economists, they're predicting or saying this is a bit more of a bear market rally, where obviously we see the drop and then the rally obviously gets up above the highest points pre-COVID-19, but then we potentially find new lows after that. There's enough data out there to support it, that's for sure. I think they conducted a bit of a survey over Bank of America Global Research. I think it was about 68 or 72% of fund managers were saying, yeah, we think this is a bear market rally. We're trading carefully at the moment. So, I suppose that's the mantra at the moment. Trade carefully, dollar cost averaging.
There's a lot of letters being thrown around with respect to what sort of recovery this is going to be. And I personally think it's going to be a W-shaped recovery. So we've had that first fall, the recovery, there'll be a second fall, and then that will be, everything's fully priced in. The market is operating with the benefit of factual, hard data, and they can make informed decisions off that. When you look at the GFC as a good example, when the GFC first fell in 2008, 2007 into 2008, it was about a 35% fall. The market then rallied 18%, off that fall, so off that bottom, and then it fell 44% again. Now, I don't think we'll see a 44% fall this time, because that was sort of elongated by the failure of Bear Stearns and Lehman Brothers. So I don't think we've got that scenario just yet. But in saying that, we have the second quarter results coming out at the beginning of July for US companies. We have Australian companies delivering their 30 June results end of July, early August. And that's going to be the coalface. That's when we're going to see the numbers. And just to explain to watchers and listeners, when it comes to pricing shares, if you see a share price that has fallen 15%, but their earnings have fallen 30%, then you know that the share price is too high. And that's when the market will react, and vice versa. If a share price has fallen 30%, but their earnings have only fallen 15%, then you know it's cheap and good value and people will buy it. And that's where the market needs that data to be able to put their hand on, okay, this is what the ramifications are, this is what's happening, we need to deal with this accordingly. So, Yeah, that's why I say we've still got a little bit more to play out with this. Economic data takes so long to come through. You know,
That's
we
right.
weren't really getting March's data until April, but that was only, you know, really COVID only kicked off in the last 2 weeks of March. So really it's been May, which was April's data, and June, which is May's data. So really everyone's operating on 2 months worth of data for the
Yeah.
biggest economic event we've seen since World War II. And I don't think we're going to see a depression. I don't think, you know, it's great to see the Feds and the Reserve Banks and all the respective central banks around the world. The amount of stimulus they're throwing around, I think, will ensure that we come out of this, you know, better than it may have happened. But in saying that, you know, like anything, different companies and sectors will recover at different rates. You know, a hospital like a Ramsay Healthcare, for example, private hospital operator, certainly going through a lot of problems right now because no elective surgeries. But as soon as they accept that back on, they'll be back at 100% capacity. People can't defer elective surgeries. However, a flight centre, people aren't travelling, and that may not travel, you know, for another couple of years. So that's I guess, the barbell effect of extremes, and there'll be a moderation between different sectors. So I think, to me, the market right now is pricing in that everyone's got to get their jobs back straight away. Everyone's back at 100% capacity. When you consider the NASDAQ hit a new high last night. So that's the crazy thing. So, you know, not only is it down, it's actually hitting your record highs. Albeit IT companies are performing, you know, pretty well through this scenario, so maybe that is justified. But when you look at the broader indexes like the S&P 500, the ASX 200, there's just, the party's not over yet.
Well, that's right. You make an interesting point there about the techs. You know, the tech stocks, it's been sort of a bit of what you call maybe a narrow bear market rally where you've got maybe 6 to 10 tech stocks over in the US, which is actually carrying that index. It's not broad. There's plenty of great business over there, which they're not operating at full capacity at all. They might be operating at 6% or not operating at all, and they're struggling, but that's not being reflected when you consider the index as a whole. So the fact that it has been quite narrow, you know, you've also got to remember that, you know, 40 million Americans have filed for unemployment. That's huge.
It's bigger than Australia.
Well, that's right. And that's in addition to what the numbers were pre-COVID-19. So
that's right.
When you consider that as a percentage, and you look at how share markets are performing, I'm really looking forward to the Q2 data coming out, because it's going to allow us to have, you know, a bit better idea of the real picture across a whole broad market rather than these narrow tech stocks that we're seeing, which is propping up the market.
Let me throw this scenario at you. The Australian Bank Index makes up 38.5% of the All Ordinaries. That's a very similar situation as well too. And, you know, it's one of the reasons why I'm not a fan of buying Australian ETFs, because the banks make up such a large part of the index, as opposed to United States and Europe, where it's about 15%. And there's, I think at last count, and I haven't seen these updated numbers for the last couple of weeks, but there's about $254 billion worth of loans on pause with Australian banks right now.
Yeah.
So pretty much larger than the market cap of the banks. Now, come September, when that honeymoon finishes, there were people who will be going back to making their repayments. The big question is going to be is what percentage don't? You know, what percentage of people out there who've lost their job personally and can't pay for their own mortgage, and then because of the Australian society's, I wouldn't call it addiction, but it's a word to that same effect, you know, of property and investing in property, how many people out there are going to can't pay their own mortgage, and also they've got 2 or 3 investment properties and their tenants can't pay their mortgages or their rents either. There could be that snowball effect, and, you know, it's, you know, on the social media, you do see the usual property spruikers out there, and they're getting noisier now than ever. And I always have a bit of a giggle, but, you know, interesting one that I didn't even consider this the other day, because they're saying first-time buyers and migrants are going to take up the slack. Well, the migrant numbers are capped for the next 3 years, and most of those migrants can't go to Sydney, Melbourne, Brisbane. They have to go to regional areas, so they're pushing people out. So all that extra supply that's coming on board in the metropolitan areas can't be taken up by migrants. But here's an interesting one. Obviously, millennials have probably been the hardest hit financially out of this whole experience. They've got very low resources, combined with their income is, you know, sort of it's either been trimmed or wiped out. And
Yeah,
what this
completely.
article was saying, it's going to take them another 2 years on top of what was normally their time frame that have to save a deposit to save up the difference to plug that gap to be able to buy a first home. So now if you were a millennial or a first home buyer and you were going to buy a house in 2 years, that's now gone out to 4 years. Unless your income has been perfect all the way along. So there are a lot of moving parts here.
Yeah, well, I mean, there's also the early access to super. Everyone's been sort of dipping their hands in the jar, pulling out the 10,000, and then the long-term effects on retirement balances. People probably, millennials, XYs, they're going to be working probably a lot longer to make up that additional, what they calculated to be about 120,000 over the life of that accumulation account, superannuation. So
I think it was 15.9 was the number yesterday, was it? It was 15.9 billion has been pulled out.
Yeah, I when I read it, I was gobsmacked. When you consider that as a percentage of the total superannuation, I can't believe it. But it's a bit of a reflection that it'd be interesting to see the percentage of individuals that have dipped into super which didn't need to, because I think that's probably skewed the numbers a bit. But even looking at other stats, a lot of Australian universities have actually said that there's been a huge increase in new applications to start new degrees and all these other things. So that's one side. Obviously, debt going up there on the HECS. When you consider long-term planning, as you said, around September, the rollback of a lot of the, I suppose, incentives that the government has released. Small business owners, they're going to struggle, if they're receiving the benefits of their GST, as well as PIG withholdings and all those sort of things being paid on their behalf by the ATOs and, obviously stimulus packages. If they're not operating at full capacity when that gets switched off, it's going to take probably an additional 3 to 6 months for their capital to dry up if things don't return. And then if they are property owners, the quickest way to access capital is selling their property, clear the debt, and then they can keep their business afloat, or, going out and getting another mortgage or whatever it might be. So I think, after September, you've got a really critical period of probably about 3 to 6 months of, saying, okay, well, this is now the game plan. What's the government going to do to keep the economy afloat? And, look at obviously where our GDP figures are. I think as we get the end of June quarter in the next few days, GDP will come out again. It'll be negative. So they'll confirm we're in a recession, because back-to-back quarters, that confirms the recession we're in right now. And okay, what does that mean for the next quarter? If we roll back all these sort of packages, what kind of debt are we actually putting ourselves in? What's the deficit going to look like? Is there any
20 years? Is it 20 years we're going to be paying this back over the next 20 years? And that's if the budget is fiscally well managed.
Yeah, I mean, even multi-generational, to be honest. I mean, I question whether it's even worth having an election this year, to be honest, just given everything that's going on. I don't see the point in it, just because at the moment it's about maintaining and keeping the economy afloat. If we get a new government in, what are they going to do? Are they going to just pull everything apart and then cause more issues down the track?
And lose momentum. I think that's the biggest thing. Is the most important part of coming out of this cycle is getting that momentum going and getting, from a psychological point of view, people re-engaging and being active again.
Yeah. Well, one of the points you made before about, I suppose, migrants is a lot of the farming and agriculture sector is struggling at the moment because they rely on a lot of these work.
Like cotton chippers and all those sort of guys,
they rely on the holiday visa workers to come out and work the farms. But that's not happening. So it means that crops could go to waste.
Wow,
and
I never thought of that.
That's a huge impact. Coles, Woolworths, Audis, that's huge when you consider blueberries and strawberries and apples. I don't want to go into it, but I was just thinking, okay, well, there's a huge sort of demographic or workforce. There's a workforce gone. So how are they going to do this? No one's really considered that, but I suppose they mentioned it. I was like, shit, you're right. There isn't a workforce for that anymore. So where's that coming from?
They rely on backpackers who fly in and, they come in on a temporary visa. They, do a bit of touring, go to the cotton farms or go to the strawberry farms or banana plantations as well, and off they go.
That's right. Just, I mean, like you said before, the snowball effect just keeps impacting industries. I suppose let's turn away from the ASX and Australian economy right now. Other things that are happening out there.
I just want to add too, and for those people on here who are clients, so if you're not a client, block your ears for the next 2 seconds, but we're actually going to be running quite an in-depth webinar in the first week of July, and we're going to be going through an incredible detail amount of technical and fundamental analysis of the markets, where they are right now, both Australian and foreign, So just keep an eye on your emails for that there, and feel free to register.
Mm-hmm. Yep, easy. And I suppose, like I said, it'll be interesting to see what the Q2 data comes out, or Q4 data for Australian side. But I mean, turning our attention away, there's talks now of that US-China trade deal getting sort of up and going again, which is hard to believe.
Yep.
China's obviously, or Australia's not really high on China's list of friends at the moment. Be interesting to see what happens there over the coming months and years around our probe into that
The
independent
Wuhan, the
inquiry.
laboratory,
Wait and see what happens. And obviously, travel ban and what that sort of means going forward for especially the tourism industry. I've heard reports from some countries that it might be 2022 until they sort of reopen the borders. So a bit concerning. I think, we've talked a fair bit on the market there, both sides. Let's talk about concessional contributions. What they are. We've mentioned them before, but there's something that is carrying over into a new financial year, which is called the Catchup concessional contribution. Brett, do you want to give me a rundown?
Step further, I was just going to say, let's explain what a concessional contribution is, because jargon gets lost on most people.
That's right. Flick it over to you.
Those people out there listening and watching, a concessional contribution, when you were working in Australia and your employer was paying you 9.5% contribution to super, that's a concessional contribution, before tax contribution. Before you receive the money yourself, it comes out of your salary, what's left over then gets taxed, and you receive the difference. So just to often find if you can phrase scenarios to people's experiences. Right. So virtually, obviously as an expat, very rarely are there employers making that contribution. So over to you.
Yeah, that's right. We all sort of have come across that, the verbiage or term super guarantee rate, 9.5% that goes in with our salary. So exactly right. Our annual concessional contribution cap is 25,000. So that if we're a normal Australian tax resident, an employee, whatever our employer is putting in, that's actually included within that cap. So if they put in 10,000 on our behalf, we've got 15,000 we can use remaining if we want to offset maybe some other sourced income, capital gains. There was the introduction of what's called the Catchup concessional contribution. Came into effect as of the end of the 2019 financial year, and it meant that if we didn't use any of that 25,000 pre-tax contribution, we can actually roll it over into the current financial year. So what that means is right now, technically we could pay in 50,000 into our super, assuming no other contributions have gone in from an employer or anything like that. And we can actually claim that as a tax deduction to offset a capital gain or some sort of income back in Australia, such as maybe net income from a property. Now, the benefit of doing that is, well, firstly, as a non-resident, our tiered tax rates start at $0 to $90,000, and our tax rate is 32.5%. Once it gets over that, then it goes up again, 37. And then once it goes up the next 90, up above 180, it's 45%. So a huge tax that we're paying. With the impact, or I suppose with this catch-up concessional contribution, we can actually roll over 5 years. So that means in 1 year, we can roll over 125,000, and in that year we can pay 150,000 into the super fund and claim it as a tax deduction. The benefit of that is, well, when we pay it in, it's only taxed at 15%. So there's a huge difference there.
Yeah.
Exactly right. And I suppose we might dovetail this in with the recent change on the main residence exemption. If you want to dive into that quickly, Brett.
Yeah, before we get people too excited about that, I obviously have the qualifying factors of being able to access the concessional contributions as well. You want to run through that?
Yeah, so very good point. Firstly, we need to have a superannuation balance of less than 500,000. That balance needed to be under 500,000 as of 30th of June in the previous financial year. So that's point one. The second point is, well, we need to be able to contribute. If we're, say, 66, 67, retired, we can't actually usually contribute because we're not working. If we meet an active work test, we can, but ordinarily we wouldn't be able to contribute. So those are usually the key parameters. Super balance as a whole. And then, if we're over 65, we need to meet what's called the active work test. So that's 40 hours across 30 days. That's the minimum criteria. But always seek advice on that as well, just to make sure you can use it.
No, sounds good. Okay, so on the main residence side, those who follow us on social media and on the emails would have seen we've pretty much shaken every tree, turned over every rock to try and get the government's attention to extend the transition period for the main residence exemption to over 1,800 people out there who did sign our petition in a very short amount of time. Thank you very much. Unfortunately, Canberra doesn't seem to be receptive of anything right now. We haven't even received any responses from either Josh Frydenberg or Scott Morrison's office. So I think it's safe to say that, the transition period is going to stand as of 30 June. And unfortunately, it's not a good scenario for expats.
No, it's not. Like you've just put it, can't really see it being turned over anytime soon. I think government has got bigger things to think about right now just due to COVID-19. I think if COVID-19 didn't take place, the pandemic, potentially it could have been changed, So it is a real shame, but it just means now going forward, we need to factor in potential capital gains tax that we might realise if we sell that property after 30th of June and we are a non-resident. And then, further on that, what tax planning can we do around reducing that capital gains tax? So that's when you can sort of see how this catch-up concessional contribution can be very useful. If we're selling a main residence as of, say, the 18th of July, signing the contract, it's got a taxable capital gain of, hypothetically, we'll say 80,000. Now, if we were to make use of the catch-up concessional contribution, in the new financial year, we can technically contribute 75,000 if that's the amount that we've accrued. So you can see there that we're actually offsetting the majority of that capital gain. 75,000 is only being taxed at 15%, whilst 5,000 is only being taxed at 32.5%. If you did the figures, you'd realise that you've actually just saved yourself thousands in tax out of pocket.
And also contributed to super in your retirement as well too, which is always that benefit as well. I think it's, you can take that two birds with one stone sort of scenario. It can help you immensely, that's for sure.
Yeah, that's right. It's, I suppose, a type of wealth transference, in your individual name and then moving into your retirement asset. And I suppose that, another strategy that some expats utilise now that this catch-up concessional contribution is in effect is, they might hold an investment property, because they're comfortable with property. They have that love affair, as we've previously mentioned. They might pay a bit of debt down. They might be banking on the property going up in value over maybe a 5 to 10 year period. Sell the investment property. They've only ever held it as a non-resident. They need to offset the capital gain. So they move the capital gain into super by way of that catch-up concessional contribution, saving themselves a bit in tax. Again, we all have a love affair with property being Australians. And obviously, if we're happy with that strategy, that's something you can do. The only pro of property is, we can use it to leverage. We might have a deposit of 100,000. Gives us the ability to gear and leverage, so we can accrue wealth in that manner. Obviously, just as risky as direct shares being more tax efficient as they're not taxable by the ATO. But that's another strategy that we'll come across with that catch-up concessional contribution. I suppose if you discuss, as an example, US tax resident, if you're in the US, you should be steering clear of contributions to your super fund due to the way the IRS will treat them, because unfortunately it'll be highly likely that the account will need to treat them as taxable, as well as it can turn our super fund into being a foreign grant or trust, which again, year-to-year reporting on the growth, income, as well as the contributions go in. So we get double tax. We don't get a foreign tax credit or anything like that. So it might mean that US tax residents will not seek to contribute to a super fund for the time they're away, but they might want to, build wealth outside of super, whether that's direct shares or maybe potentially a property purchase. But you've just got to be aware of the property that you're purchasing, because there are a lot of property spruikers around getting paid those big fat commissions as usual.
Well, I mean, my inbox is always full every day with, a lot of these spruikers offering stupid numbers in terms of commissions. And, obviously as a fee-only firm, and the only dollar that we earn is from our clients, we obviously fervently reject them. But people need to, understand that, if they are buying a property off someone, there's a loaded price covering the cost of the commission in that price.
That's right.
So,
inflated.
Yeah, exactly. And sometimes I've seen ones, I remember probably the biggest one I've ever seen was a developer sent me a message on LinkedIn saying, I've got a penthouse in Melbourne that I want to sell for north of $1 million. If you're able to find someone, I'll give you $80,000 in commissions.
Yeah, right.
And
it's ridiculous.
It is. So clearly that property's not worth that much, because otherwise you can afford to pay me, $80,000. So
that's right.
Yeah, and that's why I think, there's a big industry designed to convince people to buy a property. It is a very large percentage of the Australian economy. And just as an expat, you just need to tread carefully. You are a target. You are seen as low-hanging fruit, and a lot of people don't understand the financial or tax ramifications of a property purchase, and they get suckered in.
Yeah, that's right. And I mean, one other thing that I just wanted to raise is, when you're planning for retirement, if you are retiring back in Australia, then, your assets and growth and, wealth accumulation should be skewed firstly towards being tax efficient. Secondly, it should be ideally back in Australian dollars. So if you're engaging either an offshore plan or offshore sales consultant that's locking in these bonds or offshore investment products, remember how superannuation is structured regarding it being a tax efficient vehicle or an investment portfolio. Because as a bit of an example, just short, quickly, I've had an inquiry recently which they've engaged with a good offshore consultant who's sort of put them in a bit of a long-term strategy where all their wealth has been accumulated offshore in a foreign currency in a few different foreign offshore funds. They're 63. They plan to retire in 2 years, and their super fund balance is very unfunded. It's well beneath what it should be. And because their plans are to retire in 2 years' time, they've now got 2 years to work out how to squash as much as they can into super for their retirement. So in that case, that individual's, I suppose, wealth and assets are actually structured completely incorrectly. And it's mainly due to this one offshore advisor that's done so and structured it like that, because he's being incentivized out of the back pocket of maybe
push other products.
That's exactly right. So you've really got to think about from a retirement point of view. If I'm retiring in Australia, okay, I need to really consider best way to structure myself with my assets back in Australia, Australian dollar, reducing long-term foreign currency risk, all those key considerations. So just be mindful of that. But I might go into that. Put the pause there, Brett. What do you think?
Yeah, sorry, mate. You just the line just held up there for a sec. So I think just repeat that last sort of 2 minutes again.
Yeah, sure, mate. So all I was saying was next week I'll raise this situation. We'll go through it and pull it apart, because I think it's really good that we provide this kind of education to expats.
It's case studies.
That's right, a good case study. I'd say we wind up today's episode there. That's been good. And obviously, in the meantime, Brad, I'll be speaking to you very shortly. And thanks for joining us again, guys, on Expat Chat, episode 17.
Yeah, and just let everyone know it's been a bit of a crazy couple of months, so there's a bit of a delay between these episodes, but we're getting through, the pandemic, end of financial year, a lot of tax changes going on in Canberra. So we should be back to our normal weekly viewing. So take care, James, and mate, look forward to catch up next week on the next episode.
You too, Brett. Speak soon. Cheers.
Thanks, mate.
Bye.
Bye.